we are starting module D of Indian economy, Indian financial system. So let me begin. So here are the multiple units. Okay, you can see here. Please read these units. Why? Because this is the way you should read any subject before preparation. What is that subject contains? Is that please read one by one the slide which I am showing you here. So today, okay, as far as financial system concerned, we need not have to spend time. How many times we will be talking about financial system? Financial system is a system which mobilizes the savings and that allocation resources, and those that mobilizes and it allocates to. It deploys to. And in that process, whatever institutes are comprising, the regulatory bodies are comprising, markets are comprising, all that put together is known as financial system. And then the financial institutions, what are all those that we have discussed in detail about them? So no need to talk. Okay. So financial institution, financial market, financial instrument, financial services, these are the four pillars. And then over and above the regulator part. Okay. That's all put together is known as financial system. So in this session, when we are moving ahead, we will move ahead with understanding. So what has happened over a period of time in Indian financial system is the post reforms. See, pre-reforms, to be very frank, this financial system was not so grown up, neither it was matured. Simply everything, each and everything was done by the Reserve Bank only. So even most of the banks, they were not knowing what business they were doing, to be very frank. Because see, rate of interest on deposit was decided by RBI. Rate of interest on advances was decided by RBI. What type of business you should do, that was also decided by RBI. What you should not do, that was also decided by RBI. Then what we were doing in the branches. So neither there was any authority or any power or anything to do innovatively. But reforms made it absolutely opposite to that. And that has evolved the entire financial system in a different way. Deregulation came, the entry barriers, they were eased up, then enhanced trading and clearing in the banking as well as the capital market, money market, everywhere that has happened. Now, is the efficiency and stability of the market is improved. Now, question is how that has happened. See, what I'm talking is general. Then you may be getting a doubt, sir. What is the deregulation? What does it mean? Some of you may be aware that, see, rate of interest. Who decides the rate of interest on deposits? So individual banks, they decide. So when they decide how much deposit they should mobilize, who decides? Which period deposit to be mobilized, who decides? Everything is decided by respective bank. And that is the reason now banking across, in one bank for a period of 300 days, the rate of interest may be 7.75, whereas in another bank, the 7.7 may be for 100 days deposit, and for 300 day deposit, rate of interest may be 6.5%. Possible or not? So that is what has happened due to the deregulation. Okay, not only on that, the type of business to be done, the differential interest rate offering also. See, why some bank is giving 6% on savings bank account? That the some banks give 6% on savings bank. Now, when other banks are struggling to pay 2.75, how come the X bank advertises and tells to world that they give 6%? But it's happening. And that is the power of deregulation. Okay. So then, and everywhere there is something like that. And what is that? When that reference comes, that aspect comes, we will get to know. But this slide is very important. Make a note of every word: deregulation, entry barrier removal, trading and clearing efficiency, stability, improved stability, expanded financial instruments. See, different instruments. Earlier, the kind of instruments people have never heard about. Okay, mortgage-backed securities, credit default swap was such known instrument. No, was the options, futures were the known. But today, 50% of the bank employees are busy in futures trading. Correct? No. Now, whether they know about that, how it works, how it doesn't work, but that is not a part. But people are doing no trading. Okay. Options trading, they are doing now. Okay. So this is what. Now, as far as regulators, we have discussed. Now, here is a quick cap. Now, when we talk about the financial market, you can see here the markets are on one side money market, on another side capital market. Money market also has got primary market, secondary market, primary market, secondary. What does it mean by primary market? Primary market is a market where the security issuer is on one side. Means whosoever issues that security and mobilizes fund is on one side and investor is on another side. Whereas in the secondary market, one investor is disposing the security, another investor is investing in that. So that is the secondary market. Same case is in the capital market. So under the money market, there is a call money market, treasury bill market, commercial bill market, short-term money, short-term loans such as the commercial paper. So, okay. Then that non-convertible debentures. Okay, that is the short-term loans. Okay, so like these kind of instruments are there. And now, what is call money? What is treasury bill? That aspects we learn in detail, but just have a words to know that which are all the important aspects. Similarly, under the capital market, there is a primary market and secondary market. Under the primary market, as you know, company issues share, you buy the share. And at that, how they are issued, how they are coming to you, they may come to you by private placement, they may come to you by public issue. If that public issue is coming, that public issue may be IPO, that public issue may be right, or public issue may be the bonus. But who is issuing security? The company. That company is issuing security, you are buying. Now, from when you want to dispose of the security, some other fellow wants to buy that, and then that happens. That is happening in secondary market, and to facilitate that secondary market happening, there is a stock market. There is a stock market, that is stock exchange are there. Maybe the Bombay Stock Exchange, maybe the National Stock Exchange, maybe the over the counter exchange of India, like that. Okay, and the instruments may be the stock instrument may be the debt instrument. So this is what is about the money market and the capital market in brief. Further details about that, further details about share, further details about the bond, further details about the stock market, we'll learn later on. Okay. Now, under the money market, the call money, repo, CBLO, okay, term money, CP, CD, treasury bills, GSEC, non-SLR. No, these are all the words. No, once you know something about that, then automatically it creates the curiosity to get to know into more. Okay, we will learn. Okay, fixed income, maybe SLR security, maybe non-SLR security, maybe derivative. But there is a market, debt market under that. The fixed income markets are there, absolutely. The central government issued securities are there, or state development loans are issued by the respective state government. They are the available in this market, and where the certain fixed certainty about the income earnings are there. Okay. Whereas with regard to stock and other things, the income earning is not certain. Okay, not certain. So let us this capital market, I told you, primary market, secondary market, public issue, private placement, right issue, etc., etc. Okay, that's in capital market. So money market is the short term money, means requirement and the need, both are short term. Okay, need, requirement is short term. At the same time, investors' interest is also short term. So that's the way both the interests are met, and that short term purpose money is exchanged. What is the short term considered to be? The investment not more than 1 year period. Investment not more than 1 year period generally considered as a short term, and those kind of instruments are here under the money market. Whereas under the capital market, it is the long term area, long term aspect. See, companies, government, or the corporations, they wanted to have the investment to be made for expansion purpose, for creation of new facility purpose. And then that's where the large amount of money is needed. And that large amount of money can't be mobilized by one or two partners or 5-10 shareholders or 50-60 shareholders like that. Then they expect the large amount of people to contribute for that capital. That capital formation may be either the equity capital or otherwise the debt capital. But equity capital it is then equity shares, or otherwise the debt capital it is bond, debentures, etc. So like that, about this market when we learn, that is knowledge about the capital market. And as far as forex market concerned, I think all of you are aware that no country produces everything that needs. None of the country in the world is so self-sufficient that it manufactures or it produces whatever their countrymen requires. Okay, it is no country. So definitely every country needs something from other nation. And when that exchange of goods from one country to another country comes, so naturally there is a need comes of the emergence of other countries' currency, requirement of other countries' currency. And then that requirement of other countries' currency, when it comes, then exchange of that currency with our currency. And that is where the forex market emerges. And that forex market is, okay, is such a large one that I think world's largest deals, they happen on the forex market only. Okay, per day, it almost 9 trillion. How many? Per day. Per day exchange market turnover is how much? $9 trillion equivalent. And that is the you can say volume of the market. Okay, so therefore, let us learn about that market in a brief, whichever session it comes. But this is also part of this session. And then next we will be talking about the derivative market also. So under the derivatives, there are over-the-counter derivative and exchange-traded derivatives. Now, what is derivative? So derivative is an instrument which derives, okay, which is derived on the basis of some or other security, some or other stock, some or other bond, some currency, or something on the basis of which this instrument got devised or developed. And such kind of derived instrument is known as derivative. Okay, derivative. So therefore, this value of derivative changes in response to the original instrument based on which this instrument is deriving its value. Okay, so therefore that's the thing. So how to understand that in a very simple way? To understand that in a very simple way, let me tell you that, see, you sanction the housing loans. Do you sanction housing loans? You sanction housing loans. Let us assume that your bank's housing loan portfolio is 30,000 crore. How much? 30,000 crore. And out of this 30,000 crore, the 15,000 crore housing loans are top class. Top class means, what does it mean? That there is no single default, single scenario default. Absolutely on time EMIs, on time happening, and the value of security is almost 20,000 crore worth. The value of security against the 15,000 crore worth loan. This is the power of this your portfolio. Now, what happened? No, you suddenly means you think that you require some money, and that money you don't want to raise by raising the loans, or by raising the, you can say, the capital. You don't want to raise. You don't want to go to RBI. You don't want to go to public, and you just want that. Is there any possibility that this 15,000 can make you some money available? And that is where the derivative takes birth. So what happens now? So you are ready to give this particular portfolio, which is giving you how much income? Let us say it is giving average income to you 8% per annum. How much? 8% per annum income giving loan. Now, even if you dispose of this or give it to somebody or tell to somebody that if at all you want, so I am ready to give you the mortgage of this 20,000 crore worth properties and this loan portfolio to you at the rate of 7%. Now, then the market may decide on the basis of rate of interest scenario, the 7% interest, that too duly backed by the mortgage of worth 20,000 crore. Okay, it's fine deal. Now, that company which is ready to take it up, it will say agree to you and it will give you the 15,000 crore. Now, you got 15,000 crore money. No, did you pass your portfolio to them? No, portfolio is with you only. Okay, what has happened? You simply pass them a promise based on this 15,000 crore in the form of some bonds, and those bonds are now securitized instrument, that security instrument, and that security instrument drawing value from where? From your housing loan. Okay, now is there something is there with them? Nothing. So what is that? Simply they have given money to you and you got now the loan in books of you, but you do not have any power on that loan because till such time you don't repay to that company this 15,000 crore, that you don't have any authority. So that other company will continue to receive the loan repayments from you, and from where they will get repayment? From whatever money you repay, and that company will continue to get the 7%. Company is happy, you are happy because you got liquidity in the hands, 15,000 crore without going anywhere, you simply got in your hand. So this is what is the derivative instrument, mortgage backed security. See, you Bombay Stock Exchange, people talk every day, no? So today, BSE index fall down, NSE index fall down, BSE index gone up, NSE index gone up, isn't it? Did you hear these news every day? Of Iran and Iran attack on America, and due to war situation for the last 5 days continuously the Bombay Stock Exchange is declining trend. Okay, your day by day index is falling down. Okay, index which was at 83,000. Okay, now it is how much? That 70, 64, like that. Okay, so that is what indexes, and indexes can be for many things, not necessarily only stock index. Index can be for anything and everything. Okay, so here we will be learning about options, futures, forwards, swap, because exam point of view that is important, that part we'll learn, and we'll also learn that credit default swap. Okay, credit default swap, that part also we'll learn because that is exam point of view stated. Insurance you already learned, so no. Mutual fund we already discussed. Okay, and then we now actually overview gets completed. So here is the overview. Here is the exam question 2. What is the function of financial market? So this all are the markets, but what is the purpose they are serving? They are serving the purpose of number 1, the supply of demand, and that supply and demand only determines the price for the security. See, how come the X company, for example, Union Bank of India, it was issued at how much? 16 rupees. Now today it is priced at around 174 rupees. How this happened? Why 16 rupees share? Or actually that 16 rupee also originally 10 rupee share. Why 10 rupee share to quote at 174? Why 1 rupee share to quote at 9,400? Why 1 rupee share to quote at 17,000? Infosys. Why? Now, when it is quoted, what does it indicate? It indicates the worth of this 1 rupee. Am I right? And that is what is a price discovery or price determination. Secondly, because of this market only, the companies or organizations which are in need of money, they get the money. Now, how the money got? See, as I told you, just now, an example. See, rate of return. Everybody thinks that everyone whosoever is entering into the market, even your depositor, what he expects? He expects return, he expects assurance, he expects the safety of his money. And third important aspect is liquidity. And these with three aspects only, he comes and invests with us. Now, if he invests with us in the same way, what do you expect from the stock market? You expect from the stock market the returns. You also expect from the stock market the safety. You also expect the liquidity. Am I right? So these rate of return, when it is matching to the expectations of the investor, then I think people come and invest money. That's all. Now, why people are investing, why people are not investing in the stock market, that's altogether a different scenario. But my point of telling to you is that this is the scenario because people were not aware about the stock market. And no sooner people are getting aware about that multiple avenues are there other than the bank deposit, then people started withdrawing money from the bank deposit and diverting money to SIP. Are the people fool? People are not fool. Till such time, bankers were fooling them. Now, unless and until bankers to do something, that people need to realize that keeping money in the bank is beneficial to them, then only people will keep. Otherwise, they don't keep. Why to keep? And if that is going to be the market determinant, then you need to devise, design, and ensure that the new products to come up in such a way that the money comes to you. If it doesn't, then you also borrow money from the market and lend money in the market. That's what is ultimately job left over to banker, because that is what is the role of a banker. Then risk sharing, that also happens. So these are all the 1, 2, 3, 4, 5, 6, 7 important functions. Make a note. Most of the time this price determination, price discovery question comes, and the capital formation question comes. Okay, risk sharing. Okay, so example is quoted to you, and on the basis of that example, it is told, it will be asked to you that which function of the financial market is served in this example, and then accordingly you are asked to reply that. Okay, got my point? Otherwise, these are not new words to a banker who is a practicing banker. Neither fund mobilization, liquidity, risk sharing, access, and reduction in transaction cost and capital formation are not new words for a banker. So, and whatever return, that is self clear. And as I told you, no, I'm not here to read English for you. You are a better reader than me. Okay. Now, money market, I'm starting. Okay. Money market is as I told you already, it is a short-term fund market for short-term funds. And what does it mean by short-term fund? Short-term fund means 0 day to 365 days. Overnight to 1 year. Overnight to 1 year. You borrowed money for even overnight. That also falls in the same market and up to 365 days. That is what is number one. Number two, these whatever instruments are dealt in this money market, they are almost close substitute for money. Now again, people should not ask me, sir, what is money? We are not here to talk about money is that what money does. What is money? Money is that what money does. That's all. Many people get confused about money. Money is very powerful thing, and money need not be considered as currency. It is far, far, far beyond, far more than the currency. Currency note is only one thing. Okay, your savings bank account is also constitutes to money, because you can make use of that by swiping your debit card. Okay, your credit card limits which are given to you, that also you can make use, or any credit sanction also can be used. So all these, your fixed deposits, okay, they are also can be used, because whatever you want to buy, that buying power of you is from money what you have. It is not the currency notes what you have. Is that clear? Today I don't hold even the, today I did not had with me even the 500 rupees in my pocket currency notes, but I spent around 5,000 rupees. Okay, I purchased petrol. I paid for the FASTag, that is the toll tax, and then I traveled around 400 kilometers today. Okay, and then and after that 400 kilometers travel, bit tired, but I'm sure that my tiredness may not get reflecting in my session. Okay. I think I'm still having that my normal energy to interact with you. Okay. Then the money market functions are, okay. What money market function? Number one is it is equilibrating mechanism. Means, see, demand and supply. Now, where is the need for demand for a short-term money? Demand for short-term money comes mostly to the people who are using the funds for deploying somewhere. And that happens with the banker. See what happens, no? In a bank, you collect money from the customer, and you collect money on two counts. One is a demand deposit, another is a term deposit. Okay, demand deposit and term. For example, X is a customer who invested with you the 300 crores. Now, where did he invested? In the current account. This 300 crore are lying with you. Now, when 300 crore are received at your end, what do you do with that? Do you think that no, this fellow has kept in current account, so he may demand on any day? So let's keep that 300 crore as a balance. Do that? No. What do you do? Since you received this 300 crore, all this 300 crore and other balances put together, whatever balance is available in the RBI's account, that amount you immediately see how much can be invested in different markets, or deployed to loans. And let us see, if at all this fellow comes and withdraws 200 crore, that day someone else will deposit 200 crores. No, that is what our bankers thought. That is what and in case that day no one deposits and this fellow demands 200 crore, what to do that? Then there is a need for demand comes from your side. So other organizations like mutual fund company, insurance company, they are having large quantity of funds with them. Okay, and now they are waiting for somewhere to somebody to demand so that they can deploy. So that is how that equilibrating mechanism for the demand and supply for short-term funds is managed by money market. Okay, number two, whatever the Reserve Bank of India or Monetary Policy Committee thinks that the pricing of that need to be efficient and effectively passed on. So repo rates when are announced by repo rates when they are announced by Monetary Policy Committee expects that repo rate must get reflecting in the transactions which are happening in the money market, and then that's what the pricing also gets efficient. Because if other person is demanding more money, then you will tell that fellow that okay, I'll go to RBI and borrow from RBI. Why to borrow from you? Is that clear? So then next is the avenue for RBI intervention. So as and when liquidity problems or liquidity issue is found by RBI intervenes. Yesterday also we have seen open market operations and all that what RBI does. So in the money market, these are the few terms you must be very clear about: this call money, notice money, term money. And if you know about that, please let me know. Otherwise, we will not really invest our time. See, what is call money? Call money is overnight. Means for one day purpose, whenever somebody is borrowing and someone is lending, that is nothing but a call money. Then more than Monday, up to 14 days, it is a notice money. And beyond 14 days, up to a period of 1 year, can be considered as term money. Okay, so call money, notice money, term money, these are the terms used in the money market for borrowing and lending. Okay, and who is the regulator for money market? It is the Reserve Bank of India is the regulator. Who are all the participants in the money market? The scheduled commercial bank, including RRBs, small finance banks. See, in case if you refer any old book, if you refer, you will see excluding RRBs. Now including RRB. Excluding RRB SFBs. Now including RRB SFBs. So, okay, make a note. Otherwise, somebody may ask me, sir, we have read in one book that we have Googled, there it is telling that excluding RRB. What is correct? Are you correct or Google is correct? Now, ultimately, as I told you, no, what you have to think about it is not about the Google. You should think about the fact. And the fact is known only to the regulator. Who knows the fact? Fact knows only regulator. Who is the regulator? RBI. Go to RBI website, see the money market part, regulating money market. You will get to know the guidelines part. Okay. So as and whenever there is anywhere any doubt, like that. Okay. And open market deals are on the over the counter deals. Okay. Over the counter deals. What is mean by over the counter deals? Means the deals happens between bank to bank. Is there any market for that purpose? There is no market. Okay, like vegetable market or cloth market or jewelry market. Is there any market? There is no market. Okay, then how the deals happens? The deals happens between a bank to bank, institution to institution. Is that clear? Is that clear? And for this purpose, there is a you can say the electronic model, electronic system is devised by Reserve Bank of India, that is NDS, Negotiated Dealing Settlements Call. That this is the system RBI devised. So even if you enter into telephonic deal, you have to invariably record that deal on over this NDS call. Within 15 minutes, you have to record there.